So let's talk about activity 36. And we're talking about activity 36 now. We're going to focus a little more on why stockholders' equity changes and a little bit more about dividends. Remember the basic dividend formula. The dividend formula says beginning retained earnings plus net income minus dividends equals ending retained earnings. And remember what retained earnings are again. Retained earnings are earnings, net income of the company that was not distributed as dividends. It was kept inside the company so the company could grow. So take a moment right now. What you have in front of you, I'm going to leave this on the board so you can refer to it. Here's the statement of stockholders' equity for American Eagle. And again, you can see that this is shortened from the one that I just showed you before. It just combines certain amounts. But take a second right now and complete activity 36, and then we'll go over it. What's the value of beginning retained earnings? $1,711,929. And I got that from here. And then net income is shown right over here, $151,705. Dividends is shown over here, $87,909. Other is just given to you because it's kind of needed there to make everything work. And then the ending balance is $1,771,464. And we know that's really $1,771,464. There you go. So those would be the figures. So total stockholders' equity on January 28th, 2012 is equal to $1,416,851. And again, that's $1,416,851. All right, now here's the dividend problem, and a few people had trouble with this. This is exactly the way that it looks. It's not that bad. Assume the company issued 1 million shares of preferred stock with dividend rate of $5 a share. So preferred shareholders would receive that dividend. 1 million shares times $5 a share would be a total of $5 million in dividends. Now, who receives dividends first, the preferred or the common? Preferred. So it's not really that they receive it first. By the way, it said they get priority. But we could just say for our purposes that they get it first. Preferred shareholders always receive their dividends first, i.e. they get priority. This is part of being preferred. Therefore, the board of directors declared an $80 million dividend. How much would the preferred shareholders get? They would get their $5 million share. Just like we said, because that's what they expect. And the remainder would go to common shareholders. How much would the common shareholders receive? 75. So what happens here is that the preferred shareholders usually get what's called a stated rate, whereas common shareholders get a riskier rate depending on how profitable the company is. This is why. So you probably say, why do investors like the common shareholders, like common stock? Why don't they buy preferred stock? Because when you buy stock, do you want to receive the fixed dividend or do you want to receive a dividend with unlimited upside potential? Yeah, you want that upside potential. You want to know that the more money the company makes, the higher dividend. Therefore, preferred stock is probably not for you. Who do you think preferred stock is for? Who would want to buy such a stock that has limited upside risk? And why an old person? Yeah, you know, my parents live in Florida, and they have a house, and they have a dog, and they don't have, you know, they're going to live as long as they're going to live. God willing, they should live a really long time. but they don't have like, you know, wild expenses like younger people have. They just want to know they're going to have enough money to pay the bills. So when they make investments, they usually invest in companies, either preferred stock or more often bonds. And the income from the bonds is steady and their expenses are steady. So that sort of works itself out. Each month, the income is a little more than the expenses, and that's it. And they like that reliable fixed income. Whereas someone who's younger, like myself or like yourselves, we would look for more upside risk because we can afford to bear, you know, if you have a good year versus a bad year, that's okay with us because we're more interested in accumulating a high return. So these bumpy common stocks offer a longer, higher return over a longer period of time, and that's why we invest in them. Assume that a company has 170 million shares. Now, we haven't spoken about stock splits. Okay, so the way stock splits work is basically once a company feels like companies usually like their stock to trade in a range between $10 and $100. There are a few companies that are exceptions to this that will allow their stocks to get into $400, $500 range. But most companies like their stock to trade in a range of $10 to $100. So, per share, right? So the reason why is because people tend to think of stock prices in that range. And then they'll buy a certain, say, 1,000 shares of stock. 1,000 shares of stock can cost anywhere then between $10,000 and $100,000. So if a company's stock price is way out of whack, like Apple, I think it's in the 500s, or Google is in the 500s, then you wouldn't, if you want to buy 1,000 shares of Google, that's going to cost you $500,000. And a lot of investors are going to think, well, that's outside of my price range. I just can't, I can't afford to have a $500,000 pool. Now, someone should tell them then just buy 100 shares of stock and then you get 50,000 worth. And it's pretty much the same thing. But try telling them that. Anyway, there's a psychological thing about having stock trade in a range of $10 to $100. And this is, by the way, mostly psychological. There is a little economic factor in there, but it's not very much. So when a company's stock price looks like it's going to break 100, what a lot of companies will do is they'll split their stock. So it'll go back down again. And the way it works is very simple. It's literally, say you have a 2-for-1 stock split, it's literally split your stock. So each previous stock, the old kind of stock, let's say you have stock right now which trades for $120 a share. Then after you split your stock, then the value of the stock should be $60 a share. If you did a 4-for-1 stock split, then it should be $30 a share. So you could do a 3-for-1 stock split. I wonder whose test paper this was. Just kidding. You do a 3-for-1 stock split, let's say $120, and a 3-for-1 stock split would be $40 a share. Now, I've seen companies do a 10-for-1 stock split, which I won't even bother doing. It's kind of fun to just flip up paper, especially, I don't know why. But yeah, you could just do a 10-for-1 stock split. Let's say the stock was trading at $120, right? A 10-for-1 stock split, they would then trade at $12. Now, it's going to be that way. The stock price, sometimes people get all excited when there's a stock split because and then they have more shares of stock. But what the researchers show is that that's just a psychological effect. It doesn't have a long-term effect on the pricing of the stock. So I knew this very wealthy guy, right? And he had everything on index cards, every stock he had. I mean, he had a lot of index cards too, God bless him. Anyway, so he showed me one day, and he had a little listing of every time. He kept track of it. Every time his stock split, he did the math. He showed, look, I had 500 shares of RJ Reynolds, and then it became RJR Nabisco. I had 500 shares, and then I had 3-for-1 stock splits. So I had 1,500 shares. Then on April 2nd, 2002, they had a 2-for-1 stock splits. Then I had 3,000 shares. And he showed me how through the history, each of his stocks split so and so much many times, and now he's a very wealthy and happy person. Anyway, I'm laughing at it because I have a PhD and I learned in my PhD finance research seminars and so on. They taught us that stock splits don't mean anything. But at the same time, he's the one he's the one who's worth millions of dollars, and I'm the one who's just sitting there listening to him and making a much lower salary as a college professor. But anyway, supposedly stock splits don't have a lot of economic effect. What you really look for is earnings. The reason why his RJR stock became so valuable was because the company made a lot of profits. Yeah.
I was gonna ask, when there's a stock split at first, do people usually jump on it because they see the price go down, but over time it's really nothing?
Supposedly there are people who do. Like when a company announces stock split, it's considered to be a sign that the managers expect the stock price to go up. There's some kind of good news they haven't told everybody about yet, or that they're optimistic, and that's a sign of optimism, and therefore more people buy the stock. So there's a lot of people who say that. Long term, again, I don't think it has much effect on value. That's what the studies show. Now, with par value, it's important to know when you split stock, all you do is you dice up the par value in the same way. So let's say you have $1 par value and you split the stock 2 for 1. Then your par value would be 50 cents. Now, you could also have, just for your information, you could also have something called I'm sorry, my mind's went blank. I'm kind of zonked out today myself. You could also have something called a reverse stock split. So in that case, they would say, let's say you had this usually happens when a company's stock price drops below $1. The New York Stock Exchange in particular does not like stocks trading below $1. And if it happens for a certain period of time, they'll actually delist the stock and throw them out. So if your stock price is too low, what the company could do is something called a reverse stock split. And it's usually done like in tens. So let's say the stock price is $1 and they do a reverse 10 for 1 split. Then the new price would be about $10. And you do the same thing with the par value. Let's say the par value previously was 5 cents. Reverse 10 for 1 stock split, then the new par value would be 50 cents. So that's kind of how it works. Let's answer this question. Company has 170 million common shares outstanding, and it's a 2 for 1 stock split. How many shares would there be then? 340. Let's say there was a 3 for 2 stock split. So you go 170 times 3 divided by 2, and what do you get? 255. So shareholders still, this is the thing, is that it doesn't matter. Because, I'll give you an example. You can think about a company as a pizza pie. And there are 8 slices. And if you have 1 share, you own 1 slice. So what if, my kid comes up to me, I don't want 1 slice of pizza, I want 2 slices of pizza, right? So I take the knife and I cut the slice in half. There you go, you have 2 slices of pizza, right? Is he any better off? This only worked once, by the way, Yeah. Now I want 4 slices of pizza, that's what he said. So the idea is that you still have the same share of the company. You have 1/8 of the company. So I can cut up that slice of pizza, or I can split the stock as many times as you want. But you still have that percentage of the company, and it's only worth so much. So let's try this out. Because shareholders maintain the same proportionate share of a company's wealth before and after a stock split, the stock split has no effect on shareholder wealth. So there are studies that show that stockholders, there's a psychological thing going on, like with my friend Willie, my friend old Willie, right? There's a psychological effect also. People hear, oh, my stock is splitting, and they get all excited, and some people, there's a little bit of hype, and some people will buy the stock, and the value of the stock might go up a little while. But inevitably, it's going to go back down because it's still that percentage of the company. What really drives the stock price is not the number of splits, but it's the real value that underlies the company. Just so you know, with IFRS, for some bizarre reason that I don't know, considers, as international accounting standards, preferred stock to be a liability. And dividends on preferred stock are called interest. So now let's go through this. What effect does each of these things have on stockholders' equity? What effect does net income have on stockholders' equity? It increases it, right? Because it increases what account? Retain earnings. How about cash dividends? What effect does dividends have on stockholders' equity? It decreases stockholders' equity. How about repurchase of treasury stock? That decreases, because remember that treasury stock is negative. And reissue of treasury stock increases. So what companies could do, I should have said this and I realized it didn't. What companies could do is they could just buy back treasury stock and then resell it. So they're kind of speculating in their own stock. So if I as a company decide I'm going to buy back treasury shares, I do it. And let's say I buy it back at $17. And the value of the stock goes up to $25. There's no reason why I can't issue those shares at $25 a share and make a little profit. Now, you can't record that as profit, but you can, of course, take that income and it increases your contributed capital. Yes?
No, this is the thing, this is one thing that has been bothering me when you mentioned your friend and he kept getting doubled for the stock from over he had. Like, just because he has the stocks doesn't mean that he suddenly gets the money for it, he has to sell it, right?
Yeah.
So the one thing I don't really understand about the stock market is, so you basically amass stock, sell it, and then retry again by rebuying stock.
Well, you just hold on to the stock and let it increase in value and live off the dividends. Because he gets dividend checks in the mail all the time. Now, he reinvests most of his dividends too. So there's enough excess money coming in, enough dividends that he's not reinvesting, that he seems to be living very well.
Because I remember Professor Collins mentioned that only certain companies pay dividends.
Right. Not all companies pay dividends, but what you can always do is you can always just sell some of those shares. And so, you know, if you, Apple's not a good example. I'm trying to think of a good example of a company lately. Yeah, well, these internet companies don't pay dividends. Well, this is a great one. You follow Uber, $18 billion IPO. How could the company ever make that much money? How could it ever make back its investment? It's impossible to understand. But take a company like Uber. Let's say Uber doesn't pay dividends. Because, you know, anyone who would buy stock in Uber, I guess, just didn't need the money. But let's say it doesn't pay dividends. So, and you have Uber stock, and you need some cash, you know? For whatever reason, you need cash. So what do? Just sell the stock. That's all. Sell 100 shares, get a little money back, and then go and, you know, pay for your dog's glaucoma operation. So common and preferred stock is publicly traded. So it would be traded on an exchange like the NASDAQ.